stage, we have the one and only Hala Matar Choufany, the president of HVS Middle East. Fahad is the chief executive officer of La Crème Business Group and Millennium Hotels. Last but not least, and a legend, engineer Suaid Al-Dahiri, chief executive of Incan. And our Irish friend, Michael McGovern, director of Compass Project Management. So, without further ado, we only have 39 minutes, and let's delve into the subject. Michael, give us an overview of the current state of the project in general and the real challenges that developers are facing on costing, financing, and all the other issues that we find.
Yeah, sure. I think it's a strange mixture at the moment of bullish confidence, but it's also tinged with a little bit of skepticism in the market. I think the confidence is well-founded in the hospitality sector in general. There's $1.5 trillion of projects in the pipeline in MENA. We know that occupancy and tourist numbers are at pre-COVID levels. Governments continue to try and diversify, and they're really supportive of the hospitality sector. So, you know, there's aggressive marketing campaigns going in. There's support to airlines to open up new routes, both existing airlines and new airlines. There's also ease of visa requirements, particularly in KSA. And then within the UAE, you know, the gaming changes that are taking place currently. I think offsetting then that positivity then is just probably the more macroeconomic tone in globally. You know, obviously we've got high inflation. We've got skill shortages and worker shortages. And you know, they're real challenges to overcome. I think one of how we're seeing those translate then on the ground, particularly on the interest rates, and I know that the guys may talk about that a little bit further in terms of a developer side of it, but on the ground in project delivery side of it, there's a real issue with contractors' cash flow. You know, they're being asked to fund a lot of the project through bondage themselves, advance payment, bondage, retention bonds, performance bonds. So you could be 30-40% of a project that a contractor is funding through bonds. So that has a significant impact on their cash flow, and ultimately that comes back to the developer, particularly at the later stages. Also, I think on the skills shortages then, on the ground, that's translating to an impact on quality. We're seeing significant issues trying to retain skills, not just on contractor, but also in developers' teams. All that knowledge that has been acquired over the last 15 years, perhaps, and the market's really matured. We're seeing that. So there are significant issues that we're finding on the ground at the moment. I think developer side of it, you know, they're aware of these issues. I think they're aware that their yields, future yields, may be impacted. And I think they're now more open to have conversations around procurement, around partnering, around constructability, such as modular construction. So there is solutions, I think, there, and I think developers are now a little bit more open to have those conversations, whereas before it might have been a little bit more risk adverse. I think they're now willing to absorb some of that risk.
Engineer Sweden, obviously, Michael touched upon two critical aspects. One, talking about interest rates, so financing element, and then the other one, you know, the issue with the supply chain, contracting and fit out and that. How do you see it from your point of view, considering you have a very healthy pipeline and very large development?
So, any project starts with the feasibility. And when we start with the feasibility, we put certain criteria, which is the interest rate and the risk of the market. But what happened down the road, there's also, it goes to the development where the people start to design and the operator has putting their requirements. Now, this is where the challenge happens, because there's always a relation between the investors and the operators. And the main challenge when it comes to a requirement. And then once we finish the requirement, when we go to the market, this is where the challenge is even more, because the supply chain has to have high demand And plus, there is a shift in the market because what happened during the pandemic, there's many businesses either shrinked or closed down. And after the pandemic, suddenly the whole hospitality projects boomed in the market due to the booming tourism and development and the C class, I would say, assets class. So there's a huge demand in construction, and but it happened. There's also impact on the hospitality and delivery. And when it comes to delivery, means the skills that on the market that getting you the quality that you want. There's a challenging but as a developer, we are under control and we have an intensive. We work very closely with the contractors and the operators to ensure to minimize the risk and to make sure that the project is delivered on time. Yeah.
Michael have touched upon one area that is a critical issue. Having general contractors that are, let's say, have to comply with policies of companies to give performance bond or bank guarantee on advance money.
Yeah.
And everybody knows this. So, but how do you find it in your organization or in general in the market? Is there a solution for this problem?
There is a solution, but depends on the client. To give up certain conditions, but again, it has to be with trustable contractor. We cannot do it with any contractor, but I know there is a contractor who is financially healthy. That could be, we can work with them, and we have done it to help the contractors. At the end of the day, I'm helping my project. It's a win-win situation.
Hala, Michael Engineer Sweden, mentioned an important word that many years ago used to be a swearing word, feasibility study. It was a swearing word. We were talking about feasibility. It was like speaking to aliens. And now, are the financial return parameters that a consultant set in and forecast in a feasibility study achievable nowadays with these challenges in the market?
Well, the short answer is yes and no. I just like, instead of adding to what Michael said, I want to look at it from the external factors, which is interest rates and increased development costs, but more importantly, internal factors, and that's probably what Engineer Swaidan was hinting to when you actually go. I cannot stress enough the importance of a feasibility study. We look at a feasibility study, we are then brought into asset manager property, and ultimately we go to support the exit of the property, which is the valuation. So we really look at it from a full cycle. And clearly between the feasibility study stage, obtaining the financing, and then execution and opening door, there's a time elapse. I like to go back in conversations and to compare similar conversations. In 2014, at AHIC, we discussed on a panel value engineering. And I think this is why I want to bring it back into the feasibility study. The purpose of the feasibility study is not just to look at the IRR. That's extremely important, but I think where the importance of a feasibility study and then going to contracting and providing the brief for the architects to design and also to the operators is to specify your efficiency per key, is to specify the positioning, is to specify your facilities. Now, I'm just going to touch on my experience that yes, interest rates do fluctuate. These are market cycles, right? There is currently a supply chain, but we had it maybe 10 years ago, and we're going to have it 10 years into the future. I think essentially the feasibility study is to really look as to how are we designing, what are we over-specifying, and oftentimes the disconnect comes on the back of overspending. Very, very transparently, it is overspending. We do a feasibility study that should reflect market conditions and should reflect operators' abilities, but then we don't have any control from that point onward, other than when clients come back to updates, and there are times when we can value engineer. And just to give an example to all that I'm hinting at, if you're luxury city hotel should have 150 square meter efficiency per key, and you end up designing 220 square meter, and you end up overspending, then clearly this is 40% of your budget, and no, the IRR cannot be achieved. Now, there is a sensitivity to IRRs, right? So we say 10%, 20% cost escalation, EBITDA decline. But it is complex, it's external, but I'd like to encourage also a lot of thinking to go around the internal as developers. How are we ensuring, and that's probably where you can also add a little bit, Filippo, to this, when it comes to how are we allocating the budget? Are we allocating the right budget in line with the positioning and in line with the target market? Why do we do meeting space if we don't have a meeting segments? Why do we do the spa? Right, so I think there's a lot to the feasibility that could be realized. I mean, as consultants, we like to caveat everything and say this is indicative, right? Because we don't want to be responsible. But in reality, there are schemes that can definitely be efficient and sustainable despite the challenges that we might face as market conditions.
But we are facing markets like Dubai and Abu Dhabi in particular, and Ras Al Khaimah on par right now, where branded residencies are selling as fast and furious and at top prices. No developer want to give up any of their GFA entitlement. They want to build as much as they can, irrespective of that. So the question is, where is the red line? Where is the fine line?
Yeah, no, absolutely. And this is where, the responsibility really lies with the developer. As consultants, we come to look at a market and recommend on what is sustainable, right? And a lot of analysis goes into that, considering, the pipeline, considering economic tourism indicators, etc. And these projects are then, they go to execution, and there is, as you said, doubling of the inventory, doubling of the units. The market cannot sustain. Today you are referring to what I also consider to be slightly abnormal market conditions, right? Branded residence has always been a very interesting proposition, but not in every market and not every brand. What we're seeing today is just an opportunity to tap from different operators into this market because there is demand for it. I look at trends and opportunities that are sustainable. And when we talk about sustainability, it has to be sustainable 10 years down the road. Now, clearly, branded residence is supporting the IRRs of such projects, right? We cannot discount that at all. Not because the hotel on a standalone is not necessarily financially viable, but it's a way also for cash inflow throughout the development stage. So it's a trend. It's an exciting one. Clearly, there is a market for branded residences. But again, the question is, who is your market? Is it for live-in? Is it a secondary market? And even then, you need to specify the unit size, right? So you have the right ticket price. So I guess with any of those hospitality assets, right? When we talk hospitality, it's no more hotels. It's hotels, it's service apartment, it's co-working space, it's branded residence. It is really, as far as I'm concerned, again, from experience and having been involved, and probably that's where Fahad will talk a little bit more. I mean, as part of their acquisition or development strategy is to buy hotels, right? So we undertake those valuations, and they're at least 40% lower than the initial development cost. Now, that's not because market conditions have changed. It's because perhaps there was either an overspend or an overspecification of the areas, and therefore the income potential does not justify that investment cost. So it is not a study. I always say feasibility study is not just a study, it's the guiding principle of how you see through your exit strategy.
The good news is that somebody earlier, yesterday actually, said that in Dubai, the average price, selling price per square foot is 32% lower than 2018. Scary. So it means who wants to buy a property, good luck. It's going to be very tough, but it's also positive. Fahad, you were in two hats. CEO of a hotel company like Millennium, one of the largest worldwide, among the big guys, and but also, part of La Crane Business Group, which we all know, a very prominent investor. And these guys do the feasibilities and they set the parameter. then he goes to the developer and overspend, and then he come over to you, no pressure. You have to operate and make the money they were forecasted 3 years before. So how do you deal with that?
First of all, it is a loaded role right now, playing both hats, but it also gives us an opportunity to take a look at what is it that we can do. When we're looking at it from a developer perspective, it's very different. It's an asset that is a pride of a developer. They want to make sure that they do the best to it. Not necessarily looking at cost as the only parameter, but there's quite a few other things that they take a look at. Overspend is very natural, especially in our market. But with the current market conditions and the climate that my panelists have spoken about, higher interest rates, quality that's expected, the logistical issues that we're facing, so the inflation that's coming through in the construction costs, it's exacerbating the problem that was already there. But that also gives me an opportunity to take a look at it from an operator. What is it that we can do to put ourselves in the shoes of developers? Honestly speaking, today we are fortunate enough to have technology to support us. We are fortunate enough to have solutions that are available from an operating perspective to be able to better run and optimize operations on the ground. We're in a market today that we've seen record ADRs. If you look at the occupancy that this region is facing, it's the best performing region globally. So it's offsetting some of the issues that we're facing, but that's not the be-all, end-all of what an operator would do. So what we started doing now is planning for the future and planning better for the future. We know that the market climates that we're in today, it's temporary, right? It's a cycle that we're going through, and Hala alluded to it, and I think that's a very fair comment. And the other thing that we also need to keep in mind is globally, our expectations on yield has always been significantly higher in this region compared to anywhere else in the world. Once we start maturing as a market, I think the expectations will need to be realigned, which is something that is happening right now. But on the other side, as an operator, we always need to keep our eyes on how do we ensure that we're doing the best for the asset to ensure we come as close as possible to the feasibility that has been set. It's not an easy task, and it's a thankless task, but it's a task nonetheless that we take very seriously. So as an example, today we have launched quite a few solutions. We talk about AI, data analytics, robotics. These are realities in this market. And we can use these as an advantage to us to make sure that at least for wherever possible, we're able to control the costs to get as close to returns as possible for owners. It's not a like-for-like case, but we're getting closer to that. And on the other side is ensuring that from a revenue perspective, we have the right mix in place. So again, branded residence is something that we have gotten more and more used to in this market. And as an operator, I need to come in early enough in the discussion to ensure we have the right product mix that's coming to the market as well. Inefficiencies will always be there, and this is the nature that we work in as operators. But if we are able to influence the mix, the product that is being developed, it gives a better opportunity to achieve the results the developers will expect.
Now, obviously, with your La Crème Business Group hats, you invest. So the notion that you invest for the long term, so it means you're much more generous with the buying price, as opposed to an hedge fund that comes in and wants to go out very quickly. You know, I know this is a very nice speech, but is it actually the reality, or does the notion of long-term investment still exist, or are we all want to make real quick money?
I would slightly change the verbiage used over there and probably say that we're in the business of value creation. As a group, we look at opportunities where we can add value to the mix. If it is just a yield game, that's not the nature that most developers in this market are in for. There are a few, of course, that value long-term stable returns, while others, like ourselves, we're in the value of creating a better overall valuation in the future. The issue we face over there, of course, is in today's market, and again, Hal and I have been looking at a few transactions. The valuations are not stacking up to the reality on the ground, are not stacking up from the development cost, are not stacking up in the interest climate that we are in, and are not stacking up with investors like ourselves that are looking at creating value in these assets. So this is the challenge and disconnect that is there, but I guess it's a timing issue rather than a problem with valuations. I think the reality will set in, but the time for developers to realize what the real value is where we are facing difficulties at the moment.
Michael, obviously, these guys work very hard to set budgets, but in the last 2 days, clearly transpired that the design community complained that they've never been given a budget, as well as an incomplete brief, overspending. So you as a project management group, and quite a large one, and do multiple asset classes, how do you manage this? And the second question which tags us along is this the real problem?
So to answer the second question first, it is a problem, and I think it's actually tied into what Hala was saying. When the feasibility study is set, there's a tendency perhaps in some organizations that's handed over from the development team and it's just handed over to the delivery team without that crossover and understanding and clear brief as to why are we constructing this? What do we actually want to construct? A very simple example is development brief may have been set on a cost per key, but the brief then that's put out to the designers and the architects doesn't perhaps specify that. So the expectation that the designer it's an ultra luxurious hotel, when in fact the development team didn't want that at all. They didn't want 5-meter wide corridors; they wanted 3 meters. That's a real cost impact that you're absorbing in your cost per key or your other metrics that you're using as part of your feasibility study. So I think the solution is perhaps very easy. It's a bit more of a handover from the feasibility stage onwards, and it's also allowing the designers to design and the other project team to come in and analyze that design. Let's look at the efficiencies. Let's take our stage gates. Let's review it properly. Let's understand. Let's revert back. Are we still on the right course? So I think they're simple tools, but it probably just needs a little bit more time. And there's perhaps a tendency to push that design stage to get to market. So perhaps on a timing front, if there is a real desire to get to market quicker, I think that needs to be pulled back and maybe other avenues looked at to how to achieve those program benefits, but without sacrificing your capex.
Engineer Sweden, in the market, it appears that having in mixed use, having asset classes, so selling units to basically bring in a lot of equity, or traditional project financing seems to me the most common. Are there any other ways that you guys as an organization or in the market that developer look at in order to get project off the ground?
Normally we look at these type of assets is not, we create like a hospitality asset to create the value. But in any development, you always have to have, we're all football players, you have to have midfielders, you have to have a defense, and you have to have your attacks. Okay, your win-win, which is the villa that you can sell and you cash out right away, but the recurring asset, this is my defense line. So in the worst situation, when the pandemic happened, everybody was, renting and the supermarkets. So my defense line was working, but my offense line was not working, which is my off-plan sales, until later on picked up. So as a developer, we always have that segment, which is now we are developing in Imkan in Alger. We have a hospitality segment, but it's surrounded with the branded residence, but we tapped into the mid-clinic wellness. So we have a clinic and wellnesses together, just to bring the value. And we're retaining the asset. It's a long tail.
It's interesting in our conversation. You're very obsessed with quality. And you said in the market nowadays, there is one proxy that is tough to achieve.
Yes.
You know, why is that?
Now the market is shifting. People, they want to buy an asset that they want to live in, but they want the quality. Because the supply chain has changed a lot. And now we have different resources of material from different various of market and different quality. So the quality will differentiate you from the developer. If you just want to deliver a normal product, at one point you will be no longer in a competitive edge. So equality for us is an essential, and especially with the demographics changing across the world. People are moving from country to country. So people, their expectation is high, and we have to outstand their expectation. To maintain the quality, you need to have the right material specification, the right design, the right requirements, and the right contractor to deliver your quality. So also it's a supply, it's a chain. If you might have a good material, but your contractor cannot deliver this, so you destroy your quality. So you have to be, sometimes you have to give up a little bit from your feasibility for the quality. So later on you build your reputation, and then you can capitalize on your reputation. So it's not just build and run, no. So you have to keep your momentum. And as a developer, we are establishing company for 30, 50 years. It's not 1 year an age company, it's a long-term company. So equality is, for us, is essential.
Hala, you mentioned about valuations, you mentioned about the banks, but how do banks seize valuations? Despite, take Dubai, very strong market, even Abu Dhabi in its own right, strong market, very strong fundamental, huge vision in many new verticals, but how do banks approach valuation? Do they still chop net, discount net, or how much influential are they with consultant in pushing them towards the horizon they want, or they very much let you free to do the job?
Well, definitely it's fair to say we're seeing a correction there, right, in terms of the bank's expectations on values and the discounts they're applying. It really depends on the asset, between very established, well-performing assets and new assets. But again, what the banks have realized, and equally us when we undertake these values, that there is this disconnect. And there has been also issues with refinancing some of these projects, or even the performing assets meeting their debt obligations. So I totally understand where the banks are coming from, but I think from as a consultant and having these conversations with the banks, is that we're very much aligned. There is still a disconnect. I wouldn't think that they are discounting our valuation as per se, right? Because it does mirror the actual income potential. And I guess the purpose also is to identify what is the valuation for. What is the purpose of the valuation, right? And it makes a difference. I look at feasibility studies as being very hardcore numbers, whereas valuation is a bit of art. Because with the valuations, there's a potential to looking at what Fahad just described in terms of the yield expectations. What is the purpose of the acquisition? What is the exit strategy? So this comes into play, and that's a conversation that the banks would take into account and we can have with the bankers. Whereas in a feasibility study, it's pretty much really stating this is market conditions and that operator is likely to achieve. We're definitely seeing a lesser gap, I would say, and I agree totally with you, Fahad. We are nearing more of a correction between expectations and the income potential. And that's not because the income is going to be higher, it's because I think developers, or all developers, have realized that they need to sign it off, right? They just have to write it off. It's a check, they have to swallow that bitter pill, and they have to move on. So I think now, as we are working on more projects and we have those learnings, we have to be much more careful with those feasibility studies. And again, I stress the efficiency of projects. Hospitality, anyhow, is changing. I mean, everyone in this room would agree we've transformed. So hospitality is no longer what it used to be, a 60 square meters room. Today, it's a whole combination of different income stream, different experiences. I mean, again, to Engineer Swaidan's, what they're creating is a medical wellness with branded residence, very different to your traditional hotel model. So as complex as it is, I am of the view we have great opportunities here to actually be able to deliver on many more feasible and long-term viable projects. And if I could just add, Michael, to what you were saying about the briefs, because in fairness, I've observed at times what a feasibility study is $200,000 a key, that's the max you can spend. Otherwise, you're risking losing 2 percentage point IRR. They may not necessarily get this brief. And even if they do get the brief, perhaps the positioning is not necessarily communicated. So there's a big responsibility in how this feasibility study is then passed on, and potentially those workshops that I haven't been asked to do many of, but bring in the feasibility consultant, bring in the designers and the project manager to really look at, are we developing in line with what the market opportunity is? And I actually have a question. I know you're a moderator, but I'd love to ask you a question, Filippo, because I've observed as well that there is a lot of overspend before we get into the fit out and the final soft touches of the building. And that's sometimes where the quality is being sacrificed. I mean, you stressed a lot, Engineer Swaidan, on the quality, right?
Yes.
But sometimes when you run out of budget, we see beautiful buildings, beautiful designs, but you do walk in and it feels like, okay, they run out of budget. Clearly, I can tell they run out of budget, right?
That's true.
So what's your experience been like?
It is interesting that since I'm back into the manufacturing hat, is that I realize one thing, that the QS as a business does everything on a per square meter basis, when the supply chain of a manufacturing does in cubic meter. So there is already a disconnection how people calculate things and how things are get done. So that's the first thing I've learned, that we were pricing things based on the cubic meter, on the raw material, and the consultancy business in general, QS in particular, they price per square meter. So there is a total, one is an apple, one is a pear, first of all. Number two, everybody think that the quality of a manufacturer is based on the size of the factory, the machine they have, and how many hands they have. Well, actually it's not. It's all got to do with what we call the engineering phase, which is the feasibility stage. Is study the material, study the plans, study the specifications of what is done. So it's in the planning phases, so everything done on a desktop. And this is the critical part, that whether you are a manufacturer, whether you are a developer, or whether you are an investor, it always got to do with planning, with the very first stage of the job. But when they come to us, unfortunately, all the job is done, and they wasted 9 months of design, they wasted 3 months for tendering, and then, guess what? A famous word, value engineering. When in the old business books, they tell you to engineer value. So you just mentioned value creation. But they do the right opposite, and that's an unconventional truth, unfortunately. And, but anyhow, it's time for the audience. Are there any burning questions? We have 4 superstars in here. Let's challenge them. Yalla, please. Rami. Microphone, please. You have a lovely voice, Ramzi, but we need to hear very loud, please.
This conversation is close to my heart as well. So we've been talking about efficiency in development and maximizing the ROIs, etc., and matching up the feasibility to what we're developing. Where does the government regulatory agencies come into play? Because with the innovation that's going on in the industry, and we're changing the way we design, develop hotels and space management. Are you seeing restrictions from the current regulations? So in the ratings, and example, a bed. You need to put the bed with three side access points in Dubai to get a certain license. Are you seeing challenges towards the efficiencies that you're trying to create and a disconnect with the rules and the regulatory agencies' ratings, if that makes sense? Are you seeing improvements? I don't know, Hala, if you're working with them.
I'll pass on to Fahd on this one.
I'm happy to take that question. I mean, and that's a great question. Fortunately enough, if you compare us to anywhere else in the world, right, in this region, the government agencies are very close to having conversations with us quite regularly, be it in the kingdom, be it in the UAE or anywhere else. And a lot of these points are raised on a continuous basis. And what I've seen, at least in my experience with the operator half on, is they're very willing to accommodate with what's happening in the market. We also operate hotels outside of this region, and we know how difficult it is to get some of the government agencies to be as proactive as what I've experienced in this region. So I think your point is very valid, and I think there's still ways to go in certain areas, but these dialogues are happening quite extensively.
Any more questions? In that case, ladies and gentlemen, please join me in thanking our wonderful panelists.
Thank you. Thank you.